depreciation aspects now. So we have the opening schedule of the PPE. And what is the opening schedule of the PPE? Let's go to 2013. Let's go to 2013, which is a balance sheet and PPE for opening. So this figure you are seeing on the face of financial statement is actually closing a figure. You know, this is balance sheet. And what you have on the balance sheet is always the closing figures. So what are we going to do? We are going to copy all these figures to this closing schedule. So this is where it's going to be as a closing schedule. So I will pick it right from here. These are the closing schedule. And I will drag it down right from there. So for us to arrive at this closing figure on the face of financial statement, there are some things that must have happened. The first thing is depreciation must have been depreciated from a particular figure. An addition in the year must have also been added to that figure, plus the opening balance to arrive at this figure. So therefore, what we need to do is to pick our depreciation. And what will be our depreciation in the year? I will pick it right from our income statement. I believe there's depreciation there. And this is our depreciation here, which must have been deducted from that account in the year to arrive at that figure. I will just drag it down to get the figure straight away. Then we'll also pick the capital expenditure, that is additional assets bought for that period. Let's go back to income statement, and we'll be having capex. Do we have anything capex here? I'm trying to see. Yes, there should be under cash flow. This is it here. We see that investment in property and equipment, that is an addition to PPE. Assuming they dispose it off, it will be in brackets. It will be in a jacket. So we are going to pick this figure and drag it down. That is the addition for that year. I believe we are good with that. Now, to get this opening figure, what do we think is going to be the answer? What will have been the answer? It will be 45. That is, we will work back. This 45 plus 15 minus the depreciation. What will have been the answer? Let's take it again. It will be this closing plus depreciation, then minus the expenditure. Because this expenditure would have been there at that time, but the value of that asset will be that depreciation they remove at the end of the year, then plus that 45. So what we are saying is that the opening balance of the assets will have been 50,000 at the beginning. The same thing will happen to the next one. The same thing will happen to every other thing. So that will have been the opening balance of those assets at the beginning. So I think I should color it black so that when you see it, you will know how we got the figure. And this one should be just blue because we just picked it from that aspect. So let me make it blue. Anyone we pick directly will be in blue. That is just the rule of the game. Okay, I think we are good to go now. We are through with schedule to asset. What is the next thing to do? The next thing to do is debt and interest schedule. In case you have any question as we move on, you are free to ask so that we will settle it as we go on. So what is the opening debt? The opening debt, by the time we start that assumption aspect, you will see the technical aspects of it. This is just the normal management account we are reviewing now. So debt opening. What is debt opening here? From the statements, from the cash flow, or from the, so we have debt here under liability. So we can just drag it down to make the whole figure the way it is. Now we have issuance repayment. What is the issuance repayment from this aspect? So let's look at the issuance repayment from this aspect. We have issuance repayment. I'm trying to look at that.
Not being the cash flow.
Okay, under cash flow. Okay, thank you. So this is where it is. So we need to take it to where it's supposed to be. So I will just pick this. There's no figure in 2013. So I will pick this figure like this and then drag it down. So the 20 will appear there. But in this case, this 20 or this figure is supposed to be in negative because we are removing it from, so this one is still going to give us the same, but by the time we drag it, this will be giving us the negative aspect. So why not giving us the negative? Okay, just a minute to make it negative. Someone is asking a question. Sir, statement of changes in equity not required in financial modeling. And not, it's not, if you look at this thing we are doing, is 3 financial statement modeling. When you want to forecast, you don't actually need equity, changes in equity, because that is just based on you, on how you want to finance the organization, either through shares or through debt. It's not really what you need to forecast about, but you must be able to forecast on the cash flow, the income statement, and the balance sheet. So these are the 3 key statements you need to focus on while building the financial model. So that changes in equity is not really necessary in this aspect. So I believe I've been able to answer that question. Okay, so I think I will make this with myself. So why is it not giving me negative? Oh, okay. I have to make it format. So sorry, let me just make it in that format, which will give me the negative aspect. Okay, so let's use the formula. Okay, so let's continue. Now, this is just the schedule. This is the opening debt. I was expecting you to ask me, why are we putting it in negative? You have 50,000 at the beginning and you repay 20,000. So it means your balance should not be 30,000 again. Your balance should remain 10,000. So that's why I'm trying to put it in negative so that it will reduce that opening debt you have. You know, we are trying to have the closing debt. So that is why, that is what I'm trying to do. So in this case now, you have interest expense. And how much is the interest expense? Someone is asking a question. Is the schedule limited to 3: working capital, depreciation, and debt interest? Yes, please. The schedule is just for key things. And the key thing is just the PPE, the working capital, and then the debts and interest. So it's limited to that. So we have to bring the closing debts will be this, or let me just add it together. So just add it together to get the closing debts and you get this. So just drag it down up to this point and you are good to go. You are good to go with that aspect. Okay, so what is the interest? The interest in this case will come from interest expense. And what will be our interest expense? From this question, I'm saying our interest expense would be right from our income statement. So interest expense will be this. I believe we are still following. We have this interest expense, and that is all we have to do with our schedule. There's nothing more than that in our schedule, which we have just finished. So any other question before we continue with next step? Let me try to save it. If there's any question so far, we have been able to balance all our historical figures based on what we have here. So let me try to use the line to make it neat as it ought to be. Okay. Just a minute. Let's do everything in class to make it all right. Okay. So we're almost done. Let me try to underline the rest. So after this now, we are going to forecasting straight away. We take the assumption step by step. So we are still going back to our guidance, our manual, so that we know what is the next thing to do. So I think we are good now. So let me try to save. So after we have done all this now, let's now go back to part B. Part B now says, normal assumptions. That is the assumption given to us, or based on what we have done now, we want to calculate all these assumptions. We want to calculate all these assumptions. They say ratio based on historical figures, life scenario or life case scenario. So we are coming back here now. And we want to calculate all these figures. So what are we going to do? Let's look at the revenue growth. For 2013, we will not calculate the one of 2013, but we calculate the one of 2014. Let's go back and see the formula for it. The formula says current revenue divided by previous revenue minus 1. So we want to see revenue growth or changes. Current revenue divided by previous revenue. So let's come back here and say this is 2014. We'll say current revenue. This is current revenue divided by previous revenue. But everything will now be minus 1. And press enter. What do we have? I have 15.8. So I believe you still understand what I've done here. This says, the revenue says current revenue minus, divided by previous revenue minus 1. And if we check from this is current minus, divided by previous. We should have done it for 2013, but there's no variable to use. If we said this figure in 2013 divided by, there's no 2012. So that's why we are not calculating for 2013. Our calculation starts from 2014. And this is what we are going to get. So the formula remains the same. All you just have to do is to drag it, and we are good to go. Now, let's go to the cost of goods sold. What is the formula? Cost of goods sold says cost divided by revenue. So let's come back here. What is our cost divided by revenue? Just pick it. This one will start from 2013, since it doesn't involve any previous figure. So what is our cost? Cost divided by revenue. And we get what? We get 38.3. I will just drag it down, and I will get the whole percentage at once. Then for the next one, salary and benefits, I will come here and see salary divided by revenue. So just come back to salary divided by revenue. So what is the cost of salary? So what we are trying to say here is that what is the percentage of salary from revenue? This divided by revenue. So that we'll be able to know out of this cost, which one is taking most of our revenue, which one is taking most of our finances, our cash flow, so that you start planning towards it, how to reduce it to what we exactly needed. So I will just drag this down, and we get all the figures I need. Then for the rent and overhead, what do we have? Rent and overhead, let's see. We said direct figures. So let's see rent and overhead. It's just 10 and these figures. So we just pick it. We can also decide to use the percentage, or we can use this, but we are using the rent because rent is a fixed figure, is a fixed cost. We are using this one because they are variable costs. Cost of goods sold is a variable cost. Salary and benefit is also a variable cost. So that's why we use the percentage. But because rent is a fixed cost, that's why we are picking that figure directly from there. So we also have depreciation. Depreciation also is a variable cost because it depends on how you use that equipment, the wear and tear. So it's going to be depreciation over property and equipment. So we are going to say depreciation, which is under income statement, divided by the PPE, which is this. And we get this 42.9. So just drag it down and you are good to go. Then interest debt is going to be interest over debt. So what is the interest over debt? Interest is also here, divided by debt. Debt is coming from here. And we are good to go. Drag it down as well. All this one, if you check the assumption given to us, all these assumptions or a percentage were given to us in our assumption. So we will not be doing something like this when we get here. We will just copy and paste here. But we have to calculate all this one now before we start working on assumption tomorrow. I think we should finish this one today and start the assumption tomorrow, which should be fine and okay. So we should be able to finish that assumption tomorrow as well. So for the tax rates, we just say tax divided by earning before tax. So what is our tax here? Our tax is this, divided by earnings before tax, which is here. Ambrose, is it out before? Oh, that's true. I didn't even know that you are not complete. And the other woman as well. So others, maybe they went to cast their votes or something. Okay, so we have not gone so much like that. The video will be available. So where we have now is tax over the earnings before tax. So tax over earning before tax. What is earning before tax here? Earning before tax is this. So we get this figure, which is 31.2. So just drag it down and we are good to go. Then account receivable days. Account receivable days, let's come back to the formulas. To calculate account receivable days, we are going to say account receivable over revenue multiplied by 365 days. So all these formulas, we must know it. So what I'm going to do, once we are through with this one we are calculating, I'm going to give you another, that will be after tomorrow. When we are through tomorrow, I'm going to give you a fresh assumption, which you are going to build on your own, and you send it to me. We review it together. So account receivable over revenue. So account receivable will be here and divided by revenue, which is this. So that will not be what you are looking for. We put this one in brackets and this also in brackets. Then multiply by 365 days. and we have 18. So drag it down and we are good to go. So everything gives us 18 all through. Then we go to inventory days. How do we calculate inventory days? Inventory days is inventory over cost of sales. So I'll just come here, inventory over cost of sales. Then multiply by 365 days. And then we get our percentage as it ought to be. And we have 73 all through as well. Then for account receivable, let's review it. Account receivable will be inventory over cost. Account receivable will be account payables over cost of sales multiplied by 365 days. So we'll come back here, payable divided by cost of sales, then multiplied by 365 days. And we are good to go. So just drag it down. That is what we need to know. Then capital expenditure. Our capital expenditure, we'll just pick it directly because it's a fixed asset. So we just pick it from here. That will be addition to asset. That will be under cash flow. This figure, pick it, and you will see that is a constant figure all through. Then debt issuance, that will be repayment. For the repayment, we come to repayment part, which is this, and then drag it down as well. Then for equity share prepaid, so that will be also the direct figure from our question, so which is 70,000. So just pick that 70,000 from here, and we are good to go. So that is all we have done for today. We have been able to see all our historical figures. So if you want to do this in a real life situation, you will pick your audited account for 2013 to 2017, just the way it is, put it like that, all the figures. Then do their changes in those figures, calculate it like what we have done here, so that they will actually know that. So this is what you are going to be using to drive your forecast. So in 2018 now, you will know that in 2014, revenue increased. You will know that in 2014, revenue increased to 15.9. 15.8. In 2015, that revenue decreased. In 2016, the revenue also decreased again. In 2017, the revenue also decreased again. So in 2018 now, if the revenue now goes up, you will now need to ask yourself, what is the basis for this to go up? Are we going to continue with this revenue that is going down? What are the solutions we need to do? Then that is where the forecast come in. Then the management will start putting 1 and 2 together. How can we increase this revenue from going down situation to rise up. Then we look at the cost of sales. If we look at the cost of sales is increasing, or let's say in 2013, it increased in 2014, but from 2014 is a kind of stable. The cost was a kind of stable in 2014. Then if you look at salary increased also between 13 and 14, and in 2015 decreased, 2016 decreased, but in 2017 started going up again. So you must take note of it. What happened that this cost started going up? So financial analyst is a very deep aspect of a profession, that you have to understand the figures. You have to understand the trend of how costs increase, how revenue increase, how other aspects of financial statements increase. So that when you are giving your report, your advice to the management, they will know that, yes, this person knows what he or she is saying. Then you look at the depreciation, or let's look at the rent. The rent is a kind of stagnant. Somehow the difference is not that much. Then for the depreciation, it was a stagnant as well. Interest, stable. So it means they didn't have additional debts. The debt they have is still the same thing they are servicing. But assuming the debt increased in 2015 or 2016, you will know that there is an additional debt, or something must have happened to make that interest increase. Maybe they borrowed that money in dollar, and because of interest rates, something has happened to that interest. So you'll be able to fetch it out, tell them what happened. So looking at the tax rate here, you will see that the tax was dropping. If you look at it, if the tax was dropping here, definitely their profits before tax was also dropping, because it's supposed to be increasing, but now the tax is dropping. So definitely the earning before tax was also dropping. Let's go and see if you are right. This is earning before interest, right? And this is earning after tax. Now looking at this, now you see that this is the profit here. Earning before interest, before tax. This is earning before tax here. But the taxes was increasing because the earning before interest is also increasing. In 2013, 2014, that's profits before tax was increasing. But if you look at some elements, you will see that the figure was dropping somewhere. Let's see, the revenue was dropping from here. The revenue from year 2013, okay, the revenue also was increasing, and also the cost of sales was also increasing. So the cost of sales was increasing, the revenue was increasing. So if you want to advise them now, they should be able to manage that cost in a such a way that the cost will not grow as the revenue grows. So you have so many areas you can advise, you can put in your management report, on your report, that will actually help the management or the company you are working with or the company you are working for. Maybe it is a one-off contract. Then we look at our receivable, payable, and inventory as well as it goes. Our capital expenditure is kind of constant, 15,000 all through, without any increase. Then the payment also was on 2015, an equity issue share also was available there. So this will be the part 1 of financial modeling, which is based on historical results. So tomorrow, by God's grace, we are going to the assumption aspect, whereby we'll be making use of the assumption of the management. And then after that, we'll be representing our information on charts and graphs so that you will see how the presentation ought to look like. So any question before we call it a day? Or any suggestion?
Thank you, sir,
Yes, sir.
for the knowledge shared. So I think I would, it is possible for my clients, if they have an audited financial statement, it is possible for them to also have it in Excel. So instead of me typing from the audited financial statement, I think we can also request for their Excel computation of what was audited, so that, because by the time we are typing manually like that, it will also take time. So I don't know if that is actually possible. And then secondly, I would like to ask, this is our training. Is it sufficient enough for us to say we can write the ZFM VA examination? Is it sufficient enough for us to do that? Or we still need to do more extensive research or more study on it before we can say we want to do that? Thank you, sir.
Okay, thank you very much. For the Excel from the auditors, as audit firm, they will not be willing to give you a set format of financial statement. They will always make it in a PDF so that you won't just look at the Excel one and change figures on the financial statement. That is one reason why auditor will never give you Excel format of financial statement. They will rather PDF and send it to you. Another thing is that if they give you the Excel format, you will start looking and learning on your own. You can start looking at linking. How did they do this? How did they do this? And what you did not pay for? What is not, what do I call it? Suffer for to learn. You just learn it free of charge. That is the two main reasons why auditor will not give you the Excel format. However, you can convert that PDF to Excel and then make use of it. Just that you have to be careful when you are through with converting. You have to make sure that the figure are intact, they are correct. You check it with PDF before you continue to use the figure. But I doubt it that auditor will give you Excel format. So I'm also releasing this Excel format because you are paid for it and you are qualified to use it. Then based on the CFI or CFA exam, I will say this will help you in writing the examination, but the syllabus is very wide. If you also check my theory aspects, the last one we did previously, you will see that there are so many other aspects of financial modeling that you'll be making use of. But this one we are doing now is the major one that every company wants to know, or how to know the performance of their company. So I will say this one will not be enough for you to pass the exam, but it will assist you. It will make the work very easier for you if you are going for CFI or CFA. Are we good with that?
Yes, sir. Yes, sir. Thank you, sir.
Okay. All right. So do we have any other question before 9? Before we close
Sir,
it?
please, may I ask, how is financial modeling different from cash flow forecast? Is there any difference?
From cash flow what? Sorry.
Cash flow forecast.
Okay. It's still the same thing.
Okay.
By the time we get to, this is forecast period already now. So what we are
Yes,
doing
sir.
now, we cover income statements, balance sheet, and cash flow forecast. So we are still going to cover that area when we get there by tomorrow by God's grace.
Thank you, sir.
Hello, sir.
Okay.
Please, can we have access to, because I was not in the previous lectures, can we have access to those materials?
Okay, but have you watched the video on YouTube?
No, I haven't.
Okay, just go to House of Accountant on YouTube, or I can send the link to you for you to watch the theory aspect. Then I will forward the materials we use from the previous training.
Okay, sir, that would be kind of you.
All right, I'll forward.
Thank you so much.
Okay, so I think we are good to go now. So we meet tomorrow by 7 p.m. as well, so that we can cover the remaining aspects and then conclude it. So I said I'm going to give an assignment that you are going to build on your home. That will be after lecture tomorrow. So the video will also be available. You can watch it over and over and then use it to build the one I'm going to give you. And then interact with me as you are working on it so that you will perfect it. Don't forget, practice make perfect. So you must practice for you to actually perfect it and then start working with it, and then we are good to go. So good night. See you tomorrow.
Good night.
All right, good night.
All right, thank you, sir.
Yes, sir.